Hi, I'm Andy Temte, and welcome to the Saturday Morning Muse. Start your weekend with lessons that are designed to improve financial literacy around the world. Today is November the 15th, 2025. Last week, we explored how the telegraph, the transatlantic cable, and the stock ticker transformed securities markets by democratizing access to information. Regional markets became national and then global, and the price of information dropped dramatically, allowing middle-class investors to participate alongside the wealthy elites. But the faster transmission of information created new challenges. Today, we're exploring how investor optimism during the roaring 1920s and easy credit created conditions for the most devastating market crash in American history, and how that disaster led to the regulatory framework that defines modern securities markets. Oh, and we're going to talk about margin securities trading along the way. So, picture America in the mid-1920s. World War I had ended, the economy was booming, and new technologies like automobiles, radios, and electronic appliances were transforming daily life. Corporate profits soared as mass production drove costs down and consumer demand up. Stock prices reflected this optimism. The Dow Jones Industrial Average, which tracked 30 major companies, rose from 63 in August of 1921 to 381 by September 1929, a six-fold increase in just 8 years. This wasn't entirely irrational because many companies were genuinely profitable and growing rapidly. But something dangerous was happening alongside this legitimate growth. Widespread speculation was fueling unsustainable price increases. Remember from our railroad episode how we distinguished between investors who buy productive enterprises for long-term gains and speculators who chase short-term price movements? Well, by 1929, speculation had become pervasive in American stock markets. Now, the ability to borrow money to purchase stocks, which is a practice called margin trading, dramatically amplified both potential gains and the dangers of speculation. Margin trading creates leverage, meaning investors control more stock than their actual cash position would allow. This leverage magnifies market movements in both directions. The margin trading system worked like this. Investors could buy stocks by putting down just 10% of the purchase price and borrowing the remaining 90% from their broker or a bank. If you had $1,000, you could control $10,000 worth of stock. When prices rose, your gains were magnified tenfold. A 10% price increase on the $10,000 position that you had meant a $1,000 gain on your $1,000 original cash investment, or a 100% return after paying back the $9,000 loan. This leverage worked beautifully during bull markets, but it also created catastrophic vulnerability when prices fell. We're going to explore leverage and margin trading in much greater detail in future episodes, but for now, understand that borrowed money amplifies both gains and losses. Now, let's talk about the crash of 1929. The first cracks in the market appeared in September of 1929. Stock prices began declining from their peak, but many investors viewed this as a healthy correction, a temporary pause before the upward march resumed. Thursday, October 24th, 1929, later known as Black Thursday, shattered that optimism. Panic selling overwhelmed the New York Stock Exchange. Nearly 13 million shares traded hands, far exceeding normal daily volume. Prices plunged as sellers vastly outnumbered buyers. Now, a consortium of major bankers attempted to stabilize markets by purchasing stocks at above market prices, creating some temporary calm, but this respite was brief. On Monday, October 28th, the market dropped another 13%. And on Tuesday, October 29th, also known as Black Tuesday, was even worse. Over 16 million shares traded as investors rushed to sell at any price. Now, the ticker tape, that symbol of market information efficiency that we celebrated last week, well, it couldn't keep up. By the market's close, the ticker was hours behind actual trading, leaving investors uncertain about their losses until long after trading had ended. By mid-November, the Dow had fallen to 198, nearly half of its September peak. Investors who had bought on margin faced devastating losses. Many lost not just their stock market gains, but their entire savings. Now, the crash triggered a cascade of economic destruction. Banks that had loaned money for stock purchases faced massive defaults as borrowers couldn't repay. Many banks failed, wiping out depositors' savings and further contracting the money supply. Businesses then cut production as consumer spending collapsed. Unemployment soared from 3% in 1929 to 25% by 1933. And between 1929 and 1933, industrial production fell by nearly half. The crash had triggered the Great Depression, which would last throughout the 1930s and require World War II's industrial mobilization to finally end it. So, what caused this catastrophe? Historians and economists continued debating the precise causes, but several factors clearly contributed. Number one, excessive speculation fueled by easy credit created unsustainably high stock prices. Number two, wealth inequality meant economic growth depended heavily on continued spending by the wealthy, who pulled back sharply when markets crashed. And number three, international economic problems, including debts from World War I and trade barriers that were instituted. Remember our episode on trade and the disastrous Smoot-Hawley Act? Well, this created additional pressures. But finally, most important for our story, the complete absence of regulatory oversight allowed practices that amplified both the bubble and the crash. Now, the newly elected Roosevelt administration recognized that restoring confidence in securities markets required fundamental reform. In 1933, Congress passed the Securities Act, establishing the first federal regulation of securities markets. The Act's core principle was disclosure. Companies issuing new securities had to provide detailed financial information to potential investors. No longer could promoters make wild claims without substantiation. Registration statements had to include balance sheets, income statements, and descriptions of business operations. The Act also created legal liability for fraudulent statements. Company officers, directors, and underwriters could be sued by investors who suffered losses due to material misstatements or omissions. Now, the 1933 Act addressed new securities issuances, but existing securities still traded in largely unregulated markets. The Securities Exchange Act of 1934 extended federal oversight to secondary markets where existing securities traded. Most significantly, the Act created the Securities and Exchange Commission, or the SEC, as an independent federal agency charged with enforcing securities laws. The SEC was given broad authority to write rules, conduct investigations, and bring enforcement actions against violators. The Act also regulated stock exchanges, requiring them to register with the SEC and follow rules designed to promote fair trading. Broker-dealers had to register and maintain minimum capital requirements. Market manipulation practices that had been common in the 1920s were explicitly prohibited. Margin requirements were also reformed. The Federal Reserve was given authority to set minimum margin requirements for stock purchases. No longer could investors buy stocks with just 10% down. Initial margin requirements were set at 50%, significantly reducing leverage in the system. Now, we also have to talk about the Glass-Steagall Act. Congress addressed the banking system's role in the crash with the Glass-Steagall Act of 1933, which separated commercial banking from investment banking. Commercial banks that took deposits and made loans could no longer underwrite or deal in securities. The logic was straightforward. Banks holding depositors' money shouldn't engage in risky securities speculation. The act aimed to protect depositors from bank failures caused by securities losses. Glass-Steagall also created the Federal Deposit Insurance Corporation, or the FDIC, which insured bank deposits up to $2,500 initially. That limit is $250,000 today. This insurance dramatically reduced the risk of bank runs since depositors knew their money was protected even if their bank failed. Now, these reforms represented a philosophical shift in how America regulated securities markets. Previously, the principle had been caveat emptor, or let the buyer beware. Investors were responsible for investigating securities themselves with little regulatory protection against fraud or manipulation. The securities laws passed as part of the Roosevelt administration's New Deal, which was the name given to his administration's sweeping reforms designed to get the United States out of the Great Depression, shifted toward investor protection. The government would require disclosure, prohibit fraudulent practices, and create mechanisms for investors to recover losses from those who violated the rules. Now, this didn't eliminate risk. Stocks could still decline and investors could still lose money on bad investments, but it established a framework where decisions were based on accurate information rather than false promises and manipulation. So, until next week, we will continue the conversation. I wish you grace, dignity, and compassion. My name is Andy Temte. This is the Saturday Morning Muse. You can find the show on all the major streaming services as well as out on YouTube. Please like, subscribe, rate, and most importantly, share this public educational good with your friends, your family, your neighbors, and maybe a colleague or two. The show was produced by Nicholas Temte, and we'll see you next time on the Saturday Morning Muse.